makers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. US futures then ticking higher ahead of the AI bellwether Nvidia reporting later this week. As we mentioned, traders also juggling the data blackout from the US, which will end this week following the longest government shutdown in its history. Let's bring in Seema Shah now, Chief Global Strategist at Principal Asset Management, at the start of a big week for investors then. Seema, thank you for your time. Great to have you around the desk, of course. Let's start with the Nvidia story and what you're going to be watching for in terms of what it may tell us about that demand around AI, the key provider of these AI accelerators, the broader market implications of the earnings that drop on Wednesday. Where is your lens going to be?
Good morning, Tom. So I think, firstly, the lens has to be firmly on Nvidia, actually above any of the other details and data that's coming out this week.
To be clear, Nvidia is front and centre for you this week.
I think it is front and centre because the stakes keep rising with regards to the mega cap tech companies, with regards to whether or not they can continue to deliver on these very, very elevated expectations. And of course, with the amount of capex spending that's going on, are they going to be having their return on interest? So that has to be front and centre for us. We are quite positive about the big tech narrative, but of course there's going to be pockets of pain. And at the moment, the markets is very, very cautious and edgy with regards to how that tech narrative is going to go. So that, to us, is a key thing. The data, the macro data, of course, we've been starved of it. And we do need to really get a clearer picture. I just don't think that this week we're going to get that very clear picture. So it's all kind of building blocks, which hopefully by the next couple of weeks we'll have a clearer perspective.
OK, I want to pin a pin in the US data and come back to that. But you talked about your relative optimism still around US tech. What underpins that? And then I want to get your view on the potential pain points. What underpins your continuing constructive view on US tech then?
Yeah, I think for a lot of investors, the key thing is still the narrative about the productivity boom. That has to be the one thing that's really holding you to this. And then at the same time, the fundamentals for all of these companies continue to deliver. Even the earnings for all the other tech companies through the last couple of weeks have continued to be really positive. So they are meeting investor expectations. It's just that bar is getting higher and higher and higher. And certainly right now, with the way that the market has been trading, potentially because with a lack of data, there's just been an additional focus on the AI narrative. But it really does need to meet these hurdles. Otherwise, we could be looking at a fairly difficult couple of weeks.
In terms of the spend that we've seen on infrastructure around the AI story, do you take comfort from the fact that most of it is being done by hyperscalers that have those significant balance sheets that support that? And when it comes to debt-fueled spending, is that where the tension is? The hyperscalers can do this. The question mark's more over the OpenAIs and others that are not profitable or that are going to the debt markets?
Yeah, so there's a couple of things. So obviously at the moment, one of the key things is just on the valuation front, people asking, is this a bubble? When we're looking at the valuations and we compare it to the dot-com, we don't think it's really comparable, considerably more elevated back then. And as I said before, the fundamentals of these balance sheets are still very strong, very cash-rich. Going forward, though, the key thing is going to be how all of that capex, and these are trillions of numbers, are going to be funded. So up till this point, it's been very, very healthy. It's been really driven by the cash side. The more and more it moves to the debt-driven leverage, well, then we have more of a concern. So at the moment, we're not too concerned, but it's absolutely a market that we have to keep an eye on. And of course, not just for Nvidia, but for all the firms. But given Nvidia is the largest, that has to be the key one.
OK, let's get to the data then. And we do get the jobs data on Thursday in non-farm payrolls. But for the month of September, markets have paired their bets in terms of December. Where do you need that data before you make a clear call on December, or have you seen enough to think that the Fed makes a decision to cut next month?
Well, so I think the alternative data that we've been getting in the last couple of weeks have been on the soft side. However, they are somewhat unreliable, and there's a lot of things going on in there, specifically with regards to the government shutdown and how many of the government sector has been losing jobs. And then even on the private payroll side, again, still a lot of question marks. From our perspective, we do think that the Fed should be cutting, but the Fed, the FOMC members in the last couple of weeks have been very, very clear that they have some caution. They want to have clear evidence that there is a labour market slowdown and that interest rate cuts are required. So unfortunately, whereas typically we would say, no, the data isn't as important right now because of the FOMC and the way they've been talking, we do think that they need to have some kind of clarity. The question mark is whether in the next 3 or 4 weeks are we going to get a clear picture something that can convince them that the labour market is slowing and really requires interest rate cuts. So I would say that the December cut is very, very finely balanced. And even as we get the data, if we were to get a cut, it's going to be very finely split within the committee.
Yeah, we've seen those divisions, haven't we, amongst FOMCs, and the FOMC, and we've heard those and seen those divisions amongst Fed speakers just in recent days and weeks. I want to get your views. There's an ongoing debate around private credit and the risks within that segment of the financial system. And we've been hearing, our team in the US have been speaking to Jeffrey Gundlach, of course, the CEO of Double Line, to get his views on private credit. I want to take a listen to that and then get your take, Seema.
The next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even. But I'm very negative on that.
So that's Jeffrey Gundlach speaking on the latest episode of the Odd Lots podcast. Do you align with that view that the next market risk is going to emanate from private credit?
I think it makes sense that when investors are trying to figure out where is the next crisis going to be coming from, typically it's from where you haven't been looking. So it makes sense to look for the part of the market which is particularly opaque. So private markets certainly fits that bill, that we just don't have, of course, the mark-to-market data to be easy to track. Now, having said that, what we can see in the data that we're tracking, we can see that there are concerns, just like you do in a normal credit cycle. So there are risks growing. For an investor, that doesn't mean that you completely shun private credit. Just like in public markets, you have to pick the more defensive areas, slightly higher quality segments. So for us, private markets, private credit continues to be a really important part of your portfolio, particularly if you're looking over the next 5-10 years and reaching the returns that we need to be striving for as the environment gets a little bit more pressing. But we do think that focusing on areas such as the direct lending middle market side of the private credit market, where there is slightly more defensive nature, slightly more higher quality, is probably the area that investors should be focusing on, given that the credit cycle is moving into a more negative area.
Still an opportunity in private credit, defensive, and do your homework around what
Absolutely,
you pick. Seema
always.
Shah, thank you very much indeed on the broader markets as well. Seema Shah, Chief Global Strategist at Principal Asset Management. Now to geopolitics. China escalating its confrontation with Japan over Prime Minister Sanae Takaichi's comments on Taiwan. The diplomatic crisis risks unraveling recent progress in bilateral ties, just a few weeks, of course, after Takaichi met with Chinese President Xi Jinping and agreed to improve relations. Bloomberg's Hong Kong news desk editor Balash Pence joins me now for the latest. Balash, talk us through then this China-Japan spat, which seems to have kind of really blown up in the last 24, 48 hours or so. Where do things stand?
That's right, Tom. This is a story that dominated headlines out here in Asia, and it is emerging as the biggest diplomatic test of Sanae Takaichi's term as Prime Minister. It all goes back to earlier this month when she said that any military action around Taiwan would be a threat to Japan's survival, to which China responded, saying that this is a meddling in their internal affairs. And over the weekend, we got this travel ban, or travel advisory, rather, for Chinese citizens traveling to Japan, and also some comments in semi-official publications out of China suggesting that there may be room for more economic reprisals or some even more bellicose statements. So now Japan is trying to smooth things over a little bit. They sent a very high-level diplomat to Beijing to try to cool tensions a little bit, and they will be looking for a meeting between Takaichi and her Chinese counterpart at the G20 meeting in South Africa, although at this point there's no confirmation that such a meeting would actually happen.
OK, so maybe that meeting, if it happens, would be a sign that things are starting to ease. But so far, to your point, there's no confirmation of that. On the here and now of the economic damage done already between the two ties, and certainly China has taken a measure, hasn't it, to discourage travellers to Japan. Are we starting to see the economic impact, or what is the likely economic impact of those steps on both economies?
Well, the travel advisory in and of itself is a pretty significant step. Some estimates suggest that the damage might be as much as $14 billion. Just this year so far, almost 10 million people from China and Hong Kong together have traveled to Japan. So they make up a huge chunk of Japan's tourism industry. The last time there was a Chinese travel advisory for Japan in 2012, that cut Chinese travel about a quarter. And then they can go even further than that. Just like so many other economies, Japan is very reliant on China. China is their biggest trading partner. And Japanese manufacturers, just like so many other companies around the world, rely on Chinese rare earths, critical minerals, lots and lots of materials. So there's a lot of potential damage that could be done if the situation escalates further.
Okay, Bloomberg's Balash Pence, thank you very much for that update. A situation we'll continue to monitor, of course, the tensions between Tokyo and Beijing. Coming up, with Nvidia earnings on the horizon, we're going to talk all things tech with the president of Nasdaq. That is next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Tom McKenzie in London. Bitcoin higher this morning after a slump which wiped out its gains for the year. The cryptocurrency has fallen more than 30%, since its October highs, erasing more than $600 billion in market value. Joining me now is our senior editor for digital finance, Ana Herrera, who watches things very closely for us in the crypto space. Ana, so we're seeing the gains right now for Bitcoin up 2.2%. Ether is having a stronger session than that, up 4.1%. But this in the context of that pressure that we've seen in recent weeks and months for crypto. What's been going on? Is this? We've seen this story before. Are things different given the ETF inflows we saw at the start of the year, the regulatory focus in the US?
So it's very different, right? Normally when we had these big crashes, it was around some big event like a big exchange collapsing, multiple companies going bankrupt. But in this case, it's very confusing to people. There's no clear sign as to what. It's more, I guess maybe the asset is maturing more and it's following other asset classes, which is a bit ironic, seeing that it was supposed to not be connected to anything else. Obviously, it's interesting because the industry has all the support it needs now, the President of the United States and Congress as well. So while the environment has not changed, from the election of Trump, Bitcoin has erased all of its gains, which is really interesting. So
it's not about disappointment that the rhetoric around crypto regulation hasn't been met with real changes. Those changes have come through, and that they are continuing and will continue to support the market.
Yes. And I mean, what happened was on October 10th, there was a big flash crash, and the industry hasn't really the price hasn't really recovered as much. It's gone up and down a bit, but after those big liquidations, it sort of remained and we're entering now sort of another bear territory and perhaps another crypto winter, which is not connected to the wider environment. There's been no, jailings, as we saw the last cycle. So it's very different.
What are you watching for in the days and weeks ahead? What could be the next catalyst then?
I guess we're going to see if there are more liquidations out of crypto ETFs, because that was a big change. When the ETFs were approved, we saw a massive inflow from retail investors, and now it's not coming back. They're pulling out. I guess maybe people are becoming more sensitive and used to the big price swings, and they don't want to risk it again. And it's maybe following the wider sort of risk-off environment.
Okay, Ana, thank you very much indeed. An important update in terms of what's happening in the crypto space and giving us some context. Ana Herrera, Bloomberg's senior editor for digital finance. Ana, thank you. Now, as fears of a tech bubble continue to occupy investors' minds, one stock market being watched more closely than ever is the Nasdaq, which counts, of course, stocks such as Nvidia, Apple, Microsoft, you may have heard of these, and Google amongst its listings. Joining me now for more is Tal Cohen, the president of Nasdaq. Tal, fantastic to have you around the set with us. Let's start with, there's a lot to talk about. Let's start with what's happening in terms of the rally, and we'll risk on in the session today when you look at US futures, and tech is getting a broader lift globally as well. What are your clients saying to you? How much confidence is there that this rally has further to run?
Yeah, and Tom, thanks for having me this morning. So, number one, we've seen a lot of activity in our markets. Volatility is up. As you said, it's a risk-on environment. Our responsibility as Nasdaq is to make sure that we're supporting investor confidence. We're making sure that our markets are well-functioning, that our members can transfer risk, and that entrepreneurs can raise capital in this environment. So we don't necessarily have a view on the market. We want to just make sure that we support the market. But we are proud that many of the companies you just mentioned in the AI rally or in the tech rally are associated with Nasdaq. They're in the Nasdaq 100. So we're proud to be associated with those companies.
And given the rally, and given the spending we're seeing on CapEx, and given the valuations, if you look at companies like Palantir trading on a forward earnings of around 240, which is just remarkable, How much anxiety are you hearing? Anxiety? Are investors saying, "Look, do you guys have the protocols in place?" I mean, given the potential risk, if this unravels and something within the AI run-up bursts, there is concern amongst some that there could be pretty significant implications. How are you thinking about all of that and packaging it all together?
Well, the good news, bad news is not the first time. And so we've prepared ourselves for this moment. You know, we've had the 2001 bubble. In 2011, we had the flash crash of 2012. And since then, we put in volatility guards. We've made sure that there's harmonization across the industry. So there isn't, if you will, a tsunami of liquidity that moves from one exchange to another, where there's a lot more harmonization around that. It's not a competitive dynamic. We want to make sure that we're supporting the market. And so we're working really well with other exchanges, the industry, the regulators, feel really good about what we've been able to accomplish over the last decade. That should support the markets in terms of investor confidence and the well-functioning of the markets.
To be clear, you feel match fit if there is any significant downturn?
We've seen this before, is what I'm saying. And if we are to see, if you will, more volatility in the market, if we see it in a matter of moments in the way that we did in other occasions, we're just preparing ourselves for that moment. That's what we're always doing. We're always making sure that we have the resiliency. We've hardened our systems. We're talking to the regulators. We're talking to the industry. And we're out there watching the signs of volatility to make sure that we can handle it.
Well, given that historical perspective then, does this feel to you like an AI bubble, like a bubble?
I think it feels like that this is a transformative technology that's got incredible long-term potential that will transform the way that you and I work together, the way that industry and society thinks about this technology and interacts with the technology and the tools that are coming out. So I think it's incredibly powerful. We believe in the long-term potential of that technology, and what you're seeing here is a manifestation of it in the markets.
We were just talking about Bitcoin there in the cryptocurrency industry. You and the team at Nasdaq have made a push for regulators to allow you to have investors trade tokenized securities on the exchange, which would be a really significant test, really, of blockchain. Where are we in those negotiations? How close are we to that happening?
I'm glad you brought that up. So about 2 months ago, we put a filing into the SEC to allow for tokenized equities in the U.S. The reason we did that is to make sure that the market structure as it evolved optimized outcomes for issuers and investors. That's what our mandate would be. We also thought we could help modernize and advance the ecosystem and market structure and the way tokenization took place without impacting or compromising market integrity, investor confidence. And we wanted to show that it was simple to implement. You don't need a slew of exemptions and exceptions. And then last is we don't want two vertical silos, one in which the world of Bitcoin and other tokens exist, and then we have our traditional securities, because then you won't fulfill the promise of either tokenization and you won't take advantage of the scale that we have in the system today.
Is the SEC reciprocal to this? Are they, what are the timeframes we're looking at if they do approve this? Are you confident that they'll approve?
Well, they just came back to work. So,
yes, this is true.
Yeah, so we'll engage the SEC as we always do in a really constructive way. The rhetoric out of the SEC and the new chairman has been really, really positive towards this. They want to bring crypto under the regulatory umbrella. They want to provide regulatory clarity, and I think our filing goes a long way in helping them do that.
And if things progress as you would hope they would, we think, is this a 2026 story or beyond in terms of approval if things move forward?
Yeah, so it's more of not just Nasdaq, but it's about the industry.
Okay.
It's about the industry being ready. There's our members, there's the clearinghouse, there's regulators passing rules, and we have a lot going on in 2026. We're continuing to modernize our markets. We're talking about 24/5 trading in the U.S. There are changes to the securities information processor in the U.S. So there's just a lot going on. We need to balance all of that, but a lot of what I've just talked about are foundational to allowing for tokenization.
And you touched on 24-hour market at the Nasdaq, which is something that is in the cards as well. What's the time frame for that? When does that become a reality?
Yeah, so we're excited about that. We're already taking the work underway to make sure that we're operational and technically ready. Our mandate on that one is to make sure that we can improve the liquidity, the transparency, and the integrity of the markets to the extent that the markets are going 24/5. And in many cases, our markets are already 24/5. Retail is participating in our markets, just not on exchange. So we want to bring that in a highly regulated environment with investor confidence, help price discovery, and that's the role that we'll play.
Now, I spend a lot of time talking to tech CEOs and investors, venture capital here in Europe, and one of the constant questions is how do we keep our European entrepreneurs from migrating and listing on the Nasdaq or the S&P, listing on the New York Stock Exchange? What conversations are you having along those lines? Klarna listed in the US, that was a success for you, that was a miss for us, arguably. What's the pipeline looking like?
Just to let you know, we do have markets that we operate here in the Nordics.
Yes, you do.
We are part of the European landscape and the European story. So every issuer, they're going to make decisions based on the strategic factors and what's, if you will, individualistic to them and what they need and how they see the markets. So there's not a one-size-fits-all. The second is Sweden is a great blueprint. We're really proud of what we've been able to do in Sweden. And the things that are...
A lot of activity in Sweden.
Incredible. We're so proud of what we've been able to do in Sweden. There's three primary factors to that. One is retail. Retail is highly engaged in the market. It's the second, if you will, second largest market in terms of retail participation behind the U.S. So that it is an equity-loving culture.
Yeah.
They've put a really constructive tax regime in place. They have investment savings accounts that really motivate and send retail to go into the market. And you have a really constructive regulatory and government backdrop to that. And then the pension funds are there to anchor and support liquidity in that market. As a result of that, just a few stats, because you talked about it, is 60% of the capital raised this year across the EU has been in Sweden. We've had 5 of the top 10 IPOs. And then we had Verisure, which is the largest IPO in the last 3 years. 3.2 billion euros we raised. So that's just an incredible model that we think is a blueprint for other markets.
What is the IPO pipeline looking like in 2026? Not just for Sweden, Stockholm, but also back in the US?
Well, now that the government's back to work, we're making sure that we can release that pipeline. It's been pretty healthy all this year for certain sectors, tech in particular. Obviously, digital assets and crypto, notwithstanding the latest rally or lack thereof in crypto. But we've seen a pretty healthy market this year. We expect it to continue. We'll see what the markets bring in 2026. We have to make sure that we manage like geopolitical risk, interest rate risk, the uncertainty with the economy. So all of those factors will play into what 2026 looks like.
Fantastic to get your thoughts and insights. Thank you very much indeed. The president, of course, of Nasdaq, Cohen, joining us around the desk this Monday morning. Coming up, more hedge fund managers pair positions in Magnificent 7 stocks. We're going to have the latest details from these 13F filings. That is next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. US futures gain ahead of a big week for markets as investors look ahead to earnings from AI bellwether Nvidia and delayed US jobs data. Bitcoin briefly wipes out all its yearly gains, shedding about $600 billion from an October high, testing the resolve of crypto bulls. And China escalating its confrontation with Japan over Prime Minister Sanae Takaichi's comments on Taiwan. State media now threatening major countermeasures on top of Beijing's travel warnings. So investors getting new insights into the holdings of the world's biggest stock pickers with the latest 13F disclosures to the Securities and Exchange Commission, the SEC. Charlie Wells has been digging through the data and is here with the latest. What stands out to you, Charlie?
Tom, so what really stands out in these 13F filings is the positionings on tech. This is really where the smart money has been making moves and trying to figure out how they are going to navigate this rally despite the talk that we hear about a potential bubble. You can see here that the most significant weighting is in that tech sector, followed by financials and followed by health, consumer discretionary. But tech really in focus and questions about that rally. If you just take a look at the Nasdaq, these 13F filings are required to be sent in by anyone who invests over $100 million to the SEC, and these are for that third quarter. So you look at the third quarter, you see that upward trajectory, but still questions really at month end in July, in August, and September. Questions there in the market. You see those spilling into these 13Fs as well.
What about some of the individual names, Charlie, and maybe what they tell us about investor appetite, the kind of themes that investors are looking to tease out of these markets?
So Bloomberg has gone through some 909 of these filings for hedge funds, and we've picked out some winners and losers as far as individual names. So Nvidia, really the winner there, up some $11 billion in that third quarter, followed by Alphabet, followed by Apple. I want to flip the board and take a look at some of these losers, some that declined the most in that third quarter. What you see when I bring up these names, they're also in tech. So winners in tech, losers in tech. We've got CoreWeave here. They had a very difficult August. Shares down some 21% in the day on the back of a disappointing earnings report. So we're seeing again here that theme of investors trying to parse this rally, but also take a look at some cautious moves there as well. Let's think about individual names and the funds that are often associated with them. We've got Warren Buffett. I want to bring up a look at these two funds. We've got Warren Buffett's Berkshire Hathaway building up a significant stake in Google, but then paring back on Apple. So that pattern of kind of stop-start there too. And I've got to bring up Thiel Macro, of course, associated with Peter Thiel. They, in that third quarter, exited their entire holding in Nvidia. So questions even about these firms, even about these stocks that have been on a roll lately.
Oh, you know that Peter Thiel move is going to get a lot of traction amongst retail investors, isn't it, in the US with exposure to Nvidia. Charlie Wells, thank you very much indeed. You talk, of course, about Warren Buffett and the moves around Alphabet and Google. Let's check in on the Alphabet share price then, because pre-market you can see that pop of 5.5% for Alphabet, with Warren Buffett, of course, Berkshire Hathaway, building that stake in the parent company of Google, acquiring 17.9 million shares in Alphabet during the third quarter, and Alphabet rallying then on that news. Let's stay with tech and look at the best opportunities in Europe. My next guest says it is a pivotal moment for the continent to scale up its AI champions. Joining me now is Hala Fadel, who is the managing partner in the growth team at Eurazeo, the specialist in private markets with more than $43 billion in assets under management. Hala, thank you very much indeed. You recently, and the team recently raised, 650 million euros in your latest growth fund focused on European AI champions. Where are you finding European AI champions?
Well, thank you for having me, Tom. We're finding European champions really across the board. As you know, AI is disrupting every single sector, from coding to customer support, every task that has a bit of repetitive task or automation in it. So, for example, we invested in this super German company called Cognigy, AI for customer support, automating conversations when you're calling clients such as Lufthansa. And so this is a sector that was very prone for automation and early wins from Gen AI. And so Cognigy was also the largest European exit. We exited that company
that was your largest European exit, or
the largest AI exit in Europe.
Okay, so your LPs were happy with that.
Exactly. So just 1 month into the close of our first fund, the first close of our fund back in July, and we exited that company in September. But we're seeing also the use of Gen AI in warehouses with our recent investment here in the UK in a company called Dexery that is using robots to take constant pictures of your warehouses and creating a digital twin of the warehouse, and so that companies can have a real-time inventory with faster reach into this inventory and less time wasted on looking for inventory. So that's Dexery. They have clients like DHL or IKEA.
What is the framework that you and the team use to weed out the froth when it comes to some of these AI investments and make sure you're getting the Cognigys of the world with that successful exit? What metrics are you putting? What framework? How are you making sure that you're not getting caught short and investing in froth?
Yeah,
and hype?
That's a great question, because as you can imagine, there's lots of hype, lots of noise, lots of companies claiming or using actually Gen AI, but where's the real value? So at Eurazeo Growth, we're organized by sectors. And so every person who's leading a sector knows this sector really well and tries to map it and to identify by talking to customers ahead of a meeting with actually founders to try and see where the real value is and to try and preempt where the market trends are going to be and where those successful companies are going to be. So by having this deep knowledge of a given sector, so in this case it was the automation of customer support. We had identified Cognigy because it was very well integrated in very large enterprises, and we thought this was an edge compared to new competitors that wouldn't have had this level of integration with a big company.
More broadly, what do you say to those like the former CEO of Google, Eric Schmidt, who said that Europe has already essentially lost the AI race? It's lost on infrastructure, it's lost on large language models. It can find some value on the application layer. Do you agree with that assessment?
Well, of course not, because if you look at Europe, I mean, it's always the same thing. If you look at a funding gap or as Europe lagging behind, you can see there's something negative, but you can see it also as an opportunity to catch up. And this is what we're seeing today. I think there has been an awakening in Europe following the Draghi report that Europe has to do something about it. And both the public institutions like the European Commission and the private sector are really ramping up their investments in Europe. We can see even sectors where Europe could start leading, like defense, because of the huge amounts invested in defense, but also robotics and everything that has to do with this combination of hardware and software.
You think Europe could lead on defense?
I mean, it could definitely lead not just on defense, but on autonomous vehicles, these hybrids models between hardware and software, but also on the application layer where you don't need maybe as much capital and you just put a layer on top those large language models where European companies are already creating an edge. And these European companies starting in Europe can sell to the US market, making them at par with their US peers in terms of market opportunity.
You work with startups, you work with founders at the growth stage in particular, and you've got experience working as you prepare them pre-IPO, if that's the exit that they follow. What is the message now to your portfolio companies about the merits of staying in Europe versus the US?
So at some point, a company starting in Europe, as I mentioned earlier, need to expand into the US because it's the largest tech market in terms of customers. So at some point, some of their operations will be in the US, the same way maybe later in time a US company moves into Europe. So as long as key functions such as R&D and the product team is in Europe, which is often the case. I mean, the US is less attractive than it used to be in terms of having people excited to move to the US thanks to the geopolitical situation there. I mean, it's always been a debate, but from an investor perspective, it doesn't really matter. The company is born here. It has offices already across Europe, in the US. It doesn't matter also where it lists. I heard you speak earlier with the head of the Nasdaq. I think it's not necessarily the right debate where a company lists. It doesn't really matter as long as the operations are
So the focus should be on where the operations are rather than where the company lists.
Exactly.
Okay. Hala, thank you very much indeed. Hala Fadel, managing partner in the growth team at Eurazeo, of course. Thank you for your time. A view on the European AI space and where the opportunities are. Let's switch focus to banking right now, because the chief executive of Deutsche Bank is set to unveil his strategy for the next 3 years this afternoon. Analysts are expecting new financial targets, but few changes to the overall strategy. Joining us now is Tom Metcalf, Bloomberg's managing editor for EMEA Finance. Tom, what are investors watching for?
Yeah, I mean, they're not expecting fireworks, I would say. I mean, it's very much a continuation of what they've seen in the last 3 years, broadly speaking. I do think they expect their returns to see a boost. So Deutsche Bank might well go above 12% ROTE, which would be lovely. But it's very much a kind of continuation of effectively, what they've seen before. I think there'll be a lot of interest in the new CFO, who's making his first big public appearance, see how that goes down. But broadly speaking, when we think of Deutsche Bank, I don't think today will change the shape of that firm.
Okay, so but maybe was that the target around the return on tangible equity above 12%?
Exactly.
What would you highlight as the main challenges that remain for a bank that has had some success, to your point, over the last three years in rewriting the ship?
Yeah, exactly. Those shares have jumped up. I think it's the retail part of that. It's always proved a problem at Deutsche Bank, and it still throws out issues. A, it's pretty low margin. B, the integration issues with its IT system, they just continually come back. And it's a very hard problem to solve, but I think investors would love to see a bit of progress there. This strategy. And then just generally, it's how do you compete with the big Wall Street firms? You're undersized relative to the JP Morgans, the Goldman Sachs, and how can a Deutsche Bank set out its stall and make sure its offering is suitably sort of unique, so that customers and investors support them.
You mentioned the new CFO getting an outing of sorts then today.
Yeah.
Who is the new CFO, and what do we know about them, and what changes may come about under their leadership of that part of the business?
Yeah, so it's a gentleman called Raja Akram, and he used to be at Citigroup for about, I think, 14 years, and then Morgan Stanley, where he was deputy CFO for about 5. So he's come over, and, this will be, I think he's really taking the role early next year, but effectively where he's going to be talking about today is the look forward, right? What the strategy is going to look like under him. It'll be interesting to get to grips with a new figure in European finance. He's quite sort of risk tolerant. He rides motorbikes, and that also comes through in terms of his, his strategy, and that he's always keen to kind of, max the returns if you can.
Okay, a motorbike riding CFO. There you go. With the leathers to suit as well.
I believe so. Yeah.
Yeah. Okay. Tom Metcalf, thank you very much indeed. We have that image now. Who leads our Bloomberg EMEA finance coverage with a look ahead to a big day for Deutsche Bank and any changes that we might expect to the new CFO as well, taking the stage, or at least CFO being introduced to investors. Now, to what's happening in the airline space, and particularly the makers of aircraft. Boeing's factory workers in the St. Louis area have voted to accept the company's latest 5-year contract offer, ending the longest strike at the plane maker since 1948. This is the company has recently started production of the F-47 stealth fighter for the US Air Force. Bloomberg's Guy Johnson spoke to Boeing's Defence, Space and Security CEO, Steve Parker, on the sidelines of the Dubai Air Show early this morning, and started by asking about the ending of that strike.
It's just great to have the team back. They're the best in the business, building our fighter aircraft in St. Louis. So it's really, as they come back in today, going back through recertification work, making sure we've got all the quality standards right, and then we'll get them back on the job. But really, really pleased the strike's over with, the dispute. And just excited to get the workforce back in and get them doing what they do best, which is building some of our most advanced systems in the world.
Is there a kind of, when we've seen other strikes finishing, there's a kind of long recertification process that has been an issue and has slowed things down. Any issues with that kind of thing?
No. It's again just a very measured approach. Nothing is more important than safety and quality. So just making sure people are refreshed, we're good to go, and then we'll get them back onto the job. So take a couple of weeks, but no impacts there.
You've had a couple of clean quarters now. You've got a strike that's over, you've got a big order under your belt. It's starting to feel like a different Boeing defence business.
Well, it's early days.
Yeah.
Pleased with the progress so far. It's very simple from my perspective. It's really about our customers. So driving discipline back into program management, our engineering resources, making sure we're looking at risks and looking around corners. So it's been a good year. The team's stepping up.
But do you feel the last few years have been difficult? You must feel that this business is on the front foot now.
Well, definitely, to use a bit of a cricket term, definitely on the front foot. And again, I think you're seeing some confidence come back in, but again, just discipline, making sure we're for the new work that we're winning, we're bidding it the right way, so we can execute with scheduled margin, technical margin. But I like the progress, and I think there's going to be more to come.
More to come. Okay, let's talk about more to come and what comes next. You've got the F-47. So where is the F-47 now? I'm told you're building it.
Well, that's what the Air Force have said, so I guess I can confirm that now. But the F-47, this is the F-22 Raptor replacement for the United States Air Force, which is, Boeing, Lockheed products, amazing aircraft. This is the next generation of stealth, performance, survivability. Highly classified, so not a lot that I can say. But what I will tell you is that we invested in advance of this win. We're building new facilities in our St. Louis, Missouri and Mesa, Arizona areas. Billions of dollars of capital going in here to position us to be able to execute, and it's just head down execuation right now, working very closely with our customers.
Was the Super Hornet the last kind of ground up aircraft that Boeing new aircraft built?
From a fighter perspective, yeah. So again, this is just the next generation. We do a lot of work in the classified spaces that people don't see, and again, we've got our T-7 Red Hawk, which is really a clean sheet training aircraft, which we'll train every US Air Force fighter and bomber pilot. So think F-22, the F-47, B-21 and so forth.
So the learning curve in terms of building a new aircraft, I haven't done it for a while though. How steep has it been?
No, I think this is just what we do. So if you think about the T-7, the MQ-25 Stingray, both new aircraft that we're building right now in St. Louis. At the same time, we developed the F-15EX, a major modernization effort on the F-15. Actually, developed a lot from Saudi and Qatar with their investments on the F-15 over time. Same with our Block 3 Super Hornet. So it's just what we do.
Bloomberg's Guy Johnson speaking to Boeing's Defence, Space and Security CEO on the sidelines of the Dubai Air Show earlier this morning. Coming up, the British Prime Minister tries to regain control of the political narrative after a bruising few weeks. But the latest property sales data does not help the economic narrative. We have the details next. This is Bloomberg. Welcome back. Sales of the UK's most expensive homes plummeted in October, with the prospect of a so-called mansion tax appearing to hurt activity ahead of Labour's budget later this month. Follows a bruising few weeks, of course, for the Prime Minister Keir Starmer and Chancellor Rachel Reeves. Let's bring in our UK reporter Joe Mays. Joe, so we have the impact on the housing market, at least the top end, and a reminder of the challenges there and the uncertainty. Budget uncertainty, November the 26th. Where do things stand, Joe? So many things have been floated. Balloons have been floated. What do we know? What do we think we know about what is most likely to appear or not appear in that budget?
Well, it feels like we now know we're heading for a smorgasbord budget of lots of little tax rises in different areas of the economy, because all that controversy and drama last week where we learned that an income tax increase, which we've been expecting, is now not going to happen. But Rachel Reeves still does have a big fiscal hole to fill. And that's why we're now in the realm of talking about things like a mansion tax, or perhaps revisiting the idea of potentially increasing the bank levy, perhaps also taxes on Airbnbs, hotels, rentals, other property, also potentially in scope, pensions. It's going to be across the piece, all these different tax rises that Reeves needs to stabilise the public finances. And the risk is that we still have a few weeks to go until the budget, and this uncertainty will continue. You had the former Bank of England chief economist Andy Haldane pointing out this uncertainty is weighing on growth, weighing on sentiment. But here we are, and we've got to wait until next Wednesday to find out the details.
OK, a smorgasbord of tax changes. We'll look at the gilt markets right now, and there's money moving into gilt, so yields are down around 3 basis points across the curve, and we'll see if that smorgasbord of options will satisfy the bond markets. Meanwhile, look, the Labour Party, the government, clearly they lost their footing in terms of having the narrative, the political narrative in recent weeks. Can they regain it, Joe, do you think, with this focus on migration?
Well, I think, as ever with this policy area, the question is, does the outcome arrive of actually reducing the small boats crossings? And so far this year, clearly not. The numbers have continued to be very high, and there's no sign of Starmer succeeding on this goal of smashing the gangs. So again, it's, let's see what these latest policy reforms are from Shabana Mahmood, the Home Secretary. It's going to be changes such as, if you come and are given refugee status, you might have to return to your country from which you've come if it's later proved to be safe, for example, reducing the amount of benefits that asylum seekers get, perhaps looking again at the ECHR and articles within it which prohibits people from being deported from the UK. We're still in this realm of talking about changes to process, but whether the outcomes actually arrive, I think that's the key test. And until the public sees immigration, illegal migration falling significantly, then Labour still have their work cut out.
Yeah, delivering on policy. OK, thank you very much indeed, Bloomberg's Joe Mays, on what to expect around the budget and the new policy, at least adjustments to the migration policy that we're expecting from the UK government in focus today. Joe, thank you. Now, former Bangladeshi Prime Minister Sheikh Hasina has been sentenced to death. A special tribunal in Bangladesh found her guilty of crimes against humanity for her role in a violent crackdown of student-led protests last year. She fled to India in August of 2024 after 15 years in power and remains in exile there. Hasina says the allegations are categorically untrue. President Trump says House Republicans should vote for the Justice Department to release its files on Jeffrey Epstein, effectively reversing a position he's held for months. Trump has been under increasing pressure to release the investigative materials on the paedophile and disgraced financier who ran an underage sex ring and died in prison in 2019. Switching focus, S&P Global Ratings has lifted South Africa's credit rating for the first time since 2005. Bloomberg's chief Africa correspondent Jennifer Dabasaja joins us from Johannesburg. Jen, what do we hear from the agency then in terms of what underpinned this decision?
Well, this is quite significant, Tom. As you know, for South Africa, this country has been really dealing with high debt and weak growth for quite some time. So many investors were waiting to see what S&P, in fact, was going to point to. And many analysts are assessing the fact that it seems like there's a bit of a positive tilt to what S&P is saying. They see future growth potentially being even better than they expected, especially if we do continue to see this coalition government here, which is just about 18 months in to the term, continuing on with fiscal consolidation. And perhaps what's most important is they point to the state-owned utility provider, which is Eskom, and a lot of the improvements that we've seen with Eskom. And since this GNU has been formed here, there hasn't been load-shedding power outages, which have been hobbling the economy for many years. They hope that will continue. We did see Eskom return to positive returns earlier this year, profits, excuse me. And so they are seeing a lot of green shoots moving forward for the economy, but still there is quite a bit for the South African government to point to. But this S&P nod of approval, I guess you can say, is a welcome sign for investors. Perhaps we see some of the other ratings agencies to follow soon.
Yeah, and Jen, this happening, of course, as we gear up, as you and the team gear up for the Africa Business Summit. What are you looking ahead to? What's going to be front and centre at that event?
Well, Tom, it really front and center is where the continent is at, and also where South Africa is at leading into this presidency. Of course, we have been covering quite a bit extensively the tensions between South Africa and, of course, the United States. The United States, as far as we know, President Trump decided last week that there will not be any U.S. official representation here at the G20, but still, there are a number of other leaders that are going to be here later this week. As far as our summit goes, as you can see on the screen here, a number of business leaders living here on the continent, but even those globally who do business across the continent, very focused in on potentially what the growth looks like for several economies, South Africa included. Of course, we've covered quite extensively emerging markets and some of the momentum that they've been seeing since there's been a bit of a shift, not necessarily away from the U.S., but just diversifying portfolios. Where, in fact, are there opportunities? What are the sectors that we're looking at? Potentially, what are some of the challenges that still lie ahead? If we just bring it back to South Africa, of course, this is a vote of confidence for this S&P rating, but still there is quite a bit for business leaders to get together and figure out what more do they need to do to get more investment on the continent.
Okay. All right, Jen, we are looking forward to your coverage and interviews, of course. Bloomberg's chief Africa correspondent Jennifer Dabasaja. Up next, Bloomberg Brief. This is Bloomberg.